TV is delighted to welcome Anthony Dalwood, who's a director at LDC. Thank you for joining us, Anthony. It doesn't seem very long ago that people were talking about a wall of private equity waiting to be invested, waiting there in the wings to break over the investment opportunities. Is that still the case?
Yeah, it's very much still the case. I mean, the dry powder and the fundraisings of the last 2 years has increased the amount of dry powder, so to speak, that could be put to work. I think the opportunity to put that to work remains. However, while the valuation markets have been such that there is a drive to exit for private equity for all of the investments they've made over the last 5, 6, 7 and sometimes longer years. And that's what the markets and the private equity players have really focused on, as much as putting the money to work. I think alongside that, putting the money to work has to be driven by whether they can find deals at the appropriate values, and we should touch on that in a second. But the IPO markets have opened, and that, coupled with the fact that private equity has been looking to exit deals, has meant that they've ended up spending less than they would have done, because they are moving companies out of their portfolio rather than bringing them in. Now, of course, there is an overlap, because secondary transactions, tertiary transactions, as private equity sells to each other, means that they are spending some of the money that they've raised, or they've had, as you call, the wall of money. But they have raised money and they are exiting, and then they're putting cash back to investors. And so that wall of money being spent is not as obvious as perhaps it would have been predicted a few years ago. And we now allude into other reasons, and in particular focus is the fact that public markets are now at valuations which are relatively high compared to history in all sorts of metrics, price earnings, EBITDA multiples, cyclically adjusted earnings. And that leads to the private equity world thinking, well, do I want to spend my money on companies which perhaps are towards the peak value, and can I actually add some value to them to grow that business in excess of the multiple that I'll pay, etc. And that's not as easy when the stock markets and public markets are effectively close to all-time highs, and we've got price earnings ratios on the markets of between 15 and 20, but depending where you are in the world, historically. And so the opportunity to put money to work isn't as easy as perhaps the wall of money, as you talk about, would suggest.
That sounds as though it's a bit of a conundrum for private equity firms. I mean, you've got your investors to keep happy, I suppose, and cash isn't paying much, so you have to invest perhaps at high valuations, don't you?
It is tricky, but then the debt markets have ended up coming back into play again. They're pushing the valuations again higher in terms of the ability to get debt to put alongside a deal. So that's a double whammy. So yes, I think it is tricky to find good deals where you as an investor can add some value, hopefully grow the business, and then move it on at an appropriate time. It is hard for a PE player to do that, but arguably that's what they're paid to do. So perhaps it's this is what they're doing their job.
So are you optimistic looking forward over the next 12, 24 months?
Optimistic in terms of
what you can do with your cash to
reward your investors. There are still clearly opportunities, buyout opportunities from corporates who have not done anything with certain subscale subsidiaries or non-core subsidiaries. There are opportunities in support services and business areas where valuations still haven't reflected some of the general market levels. So there's clearly opportunities to do things again. Of course, there's also the processes. The advisors are running increasingly amount of processes as risk has returned to the system, risk appetite has returned to the system, and people want to do deals, want to put money, capital to work. So more processes are happening, which is music to a lot of private equity ears, although they maintain they don't like being part of processes. The reality is that's how they do see the majority of deals or potential deals. So there will continue to be deals, no question, but they'll also continue while the IPO window is open, as it is now, despite the fragility of the last couple of weeks. You will see as many exits as you will entries for capital, and it's for the immediate future it looks to be quite robust in its nature, despite the fact that the long-term valuations would suggest that the stock markets are reasonably fairly fully valued.
Anthony Dalwood, thank you for speaking to us this morning.
Thank you.